Advanced Audit and Assurance. Chapter 12. Assurance Services. Contents 1. Introduction and available guidance. 2. The objective and nature of assurance engagement. 3. Main types of assurance engagement. 4. Prospective financial information. 5. Pro forma financial information included in a prospectus. 6. Forensic auditing. 7. Chapter review. Introduction. Competencies. Drawing conclusions and reporting. Draw conclusions and advise on the capability to report on an assurance engagement or audit engagement, including reporting findings, giving an external audit opinion, or dealing with other issues that may require inclusion in an audit report. Draft extract of a suitable assurance report or management report based on a given scenario and entity. Evaluate and apply suitable judgment on when it may be appropriate to withdraw an opinion on, or take other such appropriate action on an audit or assurance engagement. Exam context. This is the second of 2 chapters that looks specifically at non-audit services. In this chapter, you will learn about assurance engagement performed in compliance with ISAEs 3000, 3400, and 3420. The chapter then closes with a section on forensic auditing. By the end of this chapter, students will be able to discuss the need for objective and nature of assurance engagement. Describe the steps involved in performing an assurance engagement in compliance with ISAE 3000. Explain the steps involved in performing an examination of prospective financial information in compliance with ISAE 3400. Explain the steps involved in performing an engagement to report on the compilation of pro forma financial information included in a prospectus in compliance with ISAE 3420. Describe what is involved in forensic auditing. Subtopic 1. Introduction and available guidance. Section overview. Section 1. The need for assurance services. Section 2. Available guidance on assurance engagement. Section 3. The International Framework for Assurance Engagement. Section 4. International Standard on Assurance Engagement, ISAE 3000. Section 1.1. The need for assurance services. Traditionally, the assurance role of the professional accountant has mainly been concerned with provision of audit services with a statutory framework. The audit of published annual financial statements. An audit provides a high level but not absolute level of assurance. The requirement for an audit of the annual financial statements therefore has the objective of adding assurance or credibility to the financial statements under audit. However, the management of companies and other organizations are required or expected to report to stakeholders on a wide range of information, both financial and non-financial, that is not subject to statutory audit. This might include such matters as corporate governance issues, including risk assessment and internal control system, e-commerce and the operation of e-commerce activities, systems reliability, performance measurement, both financial and non-financial, value for money, VFM. Although information about these matters may not be subject to a statutory audit, it is often considered important that the information should have credibility. Credibility may be obtained from an assurance report provided by a professionally qualified accountant. This chapter deals with the framework for the regulation of assurance reports, the objectives and key features of an assurance engagement, specific features of certain specific types of assurance engagement. Section 1.2. Available guidance on assurance engagement. Guidance on the conduct of assurance engagement is provided by the International Framework for Assurance Engagement and International Standard on Assurance Engagement, ISAE 3000. Section 1.3. The International Framework for Assurance Engagement. The International Framework for Assurance Engagement is a series of pronouncements that came into effect on 1st January 2005. The framework makes a distinction between audits and review of historical financial information regulated by ISAs and ISREs and assurance engagements other than audits and review of historical financial information. These engagements are regulated by international standards on assurance engagements, ISAEs. The framework also makes a distinction between assurance assignments that gives a reasonable level of assurance and assurance assignments that give a limited level of assurance. In assurance engagements, it is not possible to give an absolute level of assurance as a result of 1. The lack of precision often associated with the subject matter. 2. The nature of the evidence available. 3. The time scale involved. Reasonable level of assurance. Where a reasonable level of assurance is given, the risk attached to the assignment is at a sufficiently low level to enable the practitioner to give positive assurance. Reasonable assurance can only be given in the following circumstances. 1. The subject matter of the assurance service engagement is the responsibility of another party. And 2. The subject matter is identifiable and can be subjected to evidence gathering techniques. In other words, a reasonable level of assurance can be given only if the accountant is carrying out an assignment that looks at information that has not been prepared by the accountant or relates to some other subject matter that is not the responsibility of the accountant. In addition, the accountant must be able to obtain sufficient evidence for giving a positive opinion. Limited level of assurance. Where only a limited level of assurance is given, the risk is higher than that for an engagement where the accountant is able to give a reasonable assurance, but the risk is sufficiently low to allow for a negative expression of the accountant's conclusion, a negative opinion as in a review report. Section 1.4. International Standard on Assurance Engagement, ISAE 3000. ISAE 3000 assurance engagement other than audit and review of historical financial information set out basic principles, key procedures, and guidance for professional accountants referred to as practitioners when carrying out relevant assurance engagements. Key general points from ISAE 3000 are set below. 1. Ethical requirements. The IFAC ethical code should be followed. 2. Quality control. Appropriate procedures for quality control of the accountant's work should be applied to each engagement. 3. The engagement should be planned and performed with a degree of professional skepticism, recognizing that the subject matter of the engagement may be materially misstated. 4. Before completion of an assurance engagement, the client may ask for the nature of the engagement to be changed to a non-assurance engagement or for the level of assurance to be reduced. If this happens, the practitioner should consider whether the request is appropriate and should not agree to the change unless there is a good reason. Subtopic 2. The objective and nature of assurance engagements. Section Overview. Section 1. Objective of an assurance engagement. 2. The elements of an assurance relationship and an assurance engagement. 3. Suitable criteria for assessment. 4. Reporting on an assurance engagement. Section 2.1. Objective of an assurance engagement. The objective of an assurance engagement is to enable a practitioner to evaluate or measure a subject matter that is the responsibility of another party against identified suitable criteria and to express an opinion that provides the user with a level of assurance about that subject matter. Note: the accountant who carries out an assurance engagement is called a practitioner. Section 2.2. The elements of an assurance relationship and an assurance engagement. An assurance relationship is a three-party relationship between the practitioner, that is the accountant, the party responsible for the subject matter of the engagement, the intended user of the subject matter of the engagement. There will be a defined subject matter, suitable criteria for assessment, a formal engagement progress. Typically, there is an engagement for the work and the accountant gathers evidence and evaluates it. At the end of the engagement, the accountant prepares a report containing a conclusion based on the evidence that has been gathered and evaluated. Section 2.3. Suitable criteria for assessment. Suitable criteria are the standards against which the subject matter of the assignment is assessed. This can be a difficult aspect of some assurance assignments. 1. Establishing suitable criteria is relatively straightforward where regulations are involved, for example, the law or accounting standards. 2. The process is more difficult in more subjective assurance engagement in areas such as customer care or labor relations. Example: a firm of accountants takes on an engagement to report on the standard of care provided by a state-owned hospital. What criteria are used to measure the standards of patient care in the hospital? Suitable criteria might include the mortality rate of patients treated in the hospital. This might be expressed as the number of patients who die within a specified period of time after treatment. However, mortality rates are also affected by factors such as the age of patients and the seriousness of their illnesses. It is therefore not certain that mortality rate would be a suitable criterion for assessing the performance of the hospital. Section 2.4. Reporting on an assurance engagement. The reports prepared by accountants at the end of an assurance engagement will include the following elements. 1. A title indicating that the report is an independent assurance report. 2. An addressee, the person or body to which the report is addressed. 3. Subject matter of the report, including any relevant information relating to the subject matter reviewed, such as the time period for which the information was gathered. 4. Suitable criteria that have been selected for assignment. 5. Where appropriate, a statement that the use of the report must be restricted to certain specified users, or that the use of the report should be restricted to a specific purpose for which it was prepared. 6. A statement that the engagement was carried out in accordance with ISAEs. 7. A summary of the work performed. 8. The practitioner's conclusion. 9. The date, name, and address of the practitioner. As with a statutory audit report, qualifications may be required in the conclusion provided by an assurance report, where the matter involved may be material. These possible qualifications are set out in the table below. Situation and the impact on the conclusion. Limitation on scope. A qualified conclusion or disclaimer of opinion. The assertion made by the responsible party is not fairly stated. A qualified or adverse conclusion. The subject matter has been materially misstated. A qualified or adverse conclusion. The criteria are unsuitable or the subject matter is not appropriate to an assurance engagement. A qualified or adverse conclusion if users are likely to be misled. Otherwise, a qualified conclusion or disclaimer. The level of materiality that is attached to the matter giving rise to the qualification in the report is important. This will determine whether the report should be qualified or whether the accountant should give a disclaimer of opinion or an adverse opinion. Subtopic 3. The main types of assurance engagement. Section overview. 1. Engagement relating to risk assessment. 2. Engagement relating to performance measurement. 3. Engagement relating to value for money, VFM. 4. Engagement relating to systems reliability. 5. Engagement relating to e-commerce matters. 6. Continuous auditing. 4 types of assurance engagement that may be the subject of an examination question are engagement relating to 1. Risk assessment, 2. Business performance measurement, 3. System reliability, and 4. E-commerce matters. Section 3.1. Engagement relating to risk assessment. The concept of business risk assessment was introduced earlier. The concept of business risk assessment was introduced earlier. In the context of auditors using business risk assessment as part of audit approach. Obviously, businesses have systems in place to identify and monitor business risk themselves. Management will distinguish between strategic, operating, and information risk. They will analyze risk, considering potential impact on the business and probability of the risk occurring. When risks have been identified and analyzed in this way, management has to come up with strategies to manage risk. There are various strategies. 1. If risks are low impact, low probability, then they may well be accepted. 2. Higher impact risk must be dealt with, perhaps by taking out insurance against the eventuality, transferring the risk, or by putting in place internal control to prevent the risk arising. That is managing the risk. 3. If a risk is high impact, high probability, it might have to be avoided, for instance, by not taking up the new business opportunity. 4. The risks associated with e-commerce particularly are looked at below. Increasingly large companies are focusing on enterprise-wide risk management with an overall head of risk management rather than dealing with it individually on a department-by-department basis as traditionally been the case. Assurance on risk assessment. Monitoring risk assessment process is often a task carried out by internal audits, but which could equally be carried out by external parties, such as the audit firm, as an assurance engagement. Section 3.2. Engagement relating to performance measurement. The nature of performance measurement. All entities should have measurement systems for measuring and monitoring the performance of different aspects of the entity's operation and activities. Performance measurement report indicates to management whether the objectives of the entity are being achieved. Performance is measured and compared with a benchmark, such as a target or budget, or by comparing actual results with results for the previous years, or results achieved by competitors. Examples of performance measurement include sales, and whether sales targets have been achieved, profits, and whether profit targets have been achieved, cost variances and other budget variances, product quality, customer satisfaction, employee efficiency, capacity utilization, and so on. There have been significant developments in performance reporting in recent years. Many entities publish some or all of their performance measures. A wide range of performance measures may be used, including performance relating to non-financial information, such as product quality or customer satisfaction, as well as financial measures. Non-financial measures might be particularly relevant for not-for-profit organizations. In some countries, the government sets performance targets for government departments and publicly owned entities. For example, in the UK, the government publishes performance tables for schools and hospitals. Assurance, engagement, and performance. A client may ask a practitioner to provide assurance about the way in which performance measurements are calculated and presented. The practitioners will need to consider whether the performance measurement system operates as prescribed and intended. To perform such an engagement, the practitioner will need to 1. Understand the performance measurement system in use, 2. Assess and evaluate it, and 3. Test the effectiveness of its operation. Section 3.3. Engagement relating to value for money, VFM. Value for money means using resources in the best way in order to achieve intended objectives. There are 3 aspects to achieving value for money, often known as the 3 E's. 1. Economy. This means spending money carefully and not paying more than necessary for resources, materials, labor, and other expenses. 2. Efficiency. Efficiency means using resources in such a way that they produce the greatest possible amount of output. It means getting more from the use of available resources. For example, efficiency in the use of an employee means getting a high rate of output for every hour or day worked. 3. Effectiveness. Effectiveness means using resources in such a way as to achieve the desired objectives. Efficiency is of little value unless the output from the system is what the entity wishes to achieve. Entities may use their own internal audit department to carry out value for money audits. Alternatively, an external firm of practitioners may be engaged to carry out a similar task. Objective of a value for money engagement. The purpose of a VFM engagement is to investigate a particular aspect of an entity's operation and reach a conclusion about whether the entity is obtaining value for money. Economy means doing it cheaply. Measurement: compare money spent with inputs acquired. Efficiency means doing it well. The measurement is to compare inputs used with outputs achieved. Effectiveness means doing the right thing. The measurement is to compare output achieved with objectives. The practitioner's approach to a VFM engagement. The approach to performing a VFM engagement is summarized below. 1. For the particular aspect of operations that is the subject of the investigation or audit, the practitioner should identify and develop methods of measuring the 3 E's: measurement of economy, efficiency, and effectiveness. 2. It is often necessary to assess the 3 E's by making comparisons. The practitioner should therefore establish an appropriate basis for making comparisons, such as economy, efficiency, and achievement in previous periods, comparisons with other entities, comparisons with targets, and possibly comparison with national averages. 3. Having gathered and analyzed measurements of the 3 E's, the practitioner should reach a conclusion. Are the 3 E's being achieved for the operation that have been the subject of the investigation? 4. If appropriate, the practitioner should identify areas of weakness and make appropriate recommendations to the client about improvements that should be made. Section 3.4. Engagement relating to system reliability. Even if an entity is not specifically involved in e-commerce activities, it is likely that a large part of its internal information processing will be computer-based. Major systems failure would therefore make it difficult for many entities to operate effectively, especially if they use online systems for their transaction processing. Management and other stakeholders may therefore engage a practitioner to give assurance on the effective and secure operation of their computer systems. The general approach that the accountant should take for this assurance engagement is similar to the approach to be taken for e-commerce activities, which we shall look at below. However, the accountant's work will focus more on identifying, evaluating, and testing controls within the company's information systems. The website aspects that are important for e-commerce engagement are less significant for engagement relating to systems reliability. Computer-assisted audit techniques, CAAT, such as audit software and test data, are likely to be used by the accountants to carry out the work. CATs were described in an earlier chapter. Section 3.5. Engagement relating to e-commerce matters. Entities may use information technique to conduct business transactions using 1. E-commerce or entities may use information technology to conduct business transactions using 1. E-commerce or 2. Electronic data interchange, EDI. EDI is the process of transferring documents between the computer system of different entities. An extension of EDI, known as SET, Secure Electronic Transmission, is used to process money transfers electronically for credit card and debit cards. E-commerce is a general term that refers to trading electronically at distance between the buyer and seller. Business transactions take place electronically rather than face-to-face or in a paper-based system. Rapid development in information technology in recent years have led to substantial growth in the volume of e-commerce. Most most e-commerce activity is carried out over the internet, with customers buying goods or services through the website of sellers. An important aspect of e-commerce is that users of an e-commerce system need to have trust in the integrity of the system. This means that a customer buying from a remote seller must be confident that the seller is genuine and will deliver the goods that the buyer purchases. Similarly, the seller needs to be confident that the buyer has properly identified himself and can be trusted to pay. Both the buyer and the seller need to be confident that the details of their transactions will not be intercepted by a third party, because they want the details of the transaction to be kept confidential. For example, the name and credit card number of the buyer has to be kept confidential, and there must be no risk of an unauthorized person intercepting and then making use of the buyer's credit card detail. Risk and risk management with e-commerce. Risk arise from the use of e-commerce systems, such as a loss of transaction integrity, increased security risk with remote trading than with face-to-face trading or paper-based trading transactions. The use of inappropriate accounting policies, for example, in respect of the capitalization of website development costs. Legal and regulatory risk. This is the risk, for example, that e-commerce activities may be breaking the law in some countries. In addition, the internal controls for an e-commerce system may be efficient, but there may not be an adequate audit trail for checking transactions and confirming that the controls are efficient. Management responsibility for e-commerce risk. As in all risk situations, management should evaluate the risks to which the entity is exposed and take appropriate action to manage those risks. The general approach that should be taken is summarized below. 1. Management should carry out risk assessment exercises on a regular basis. 2. Management should create an appropriate control environment, including an information system security policy. 3. The entity should make appropriate use of an internal audit function to obtain assurance that the e-commerce system is functioning properly. 4. There should be adequate audit trail for e-commerce transactions. 5. The entity should keep up-to-date backup copies of data files. 6. For some systems, it may be appropriate to use encryption for data. Encryption involves the electronic conversion of data into a secure coded language for transmission, so that it will be incomprehensible to anyone who intercepts it in transmission. 7. The system user should comply with generally recognized standards and register with the Web Trust or similar organization. Note: the Web Trust is an organization established to provide confidence to customers using e-commerce. The Web Trust gives a seal of approval to websites, and customers who use a website that has the trust seal of approval can have confidence that their transactions are secure. Specially licensed accountants grant this seal, which has to be renewed every 3 months on behalf of the trust. The accountants confirm that the controls operated by the site comply with the regulations of the trust. The e-commerce audit. A firm of accountants may be engaged by a client to provide assurance about the integrity of transactions on the client's website, and that the client's e-commerce system is suitably protected from risk. Performing an assurance engagement on electronic processing systems provides additional challenge for auditors. These include 1. The need for specialist knowledge about e-commerce system. 2. Problems that may arise when some aspects of the e-commerce system, such as the electronic payment system, are outsourced by the client to another entity. 3. The role of the client's internal auditor in monitoring the integrity of the e-commerce system. 4. The need for specialist controls, general and application controls for the system. 5. Possible problems of independence and conflict of interest if the audit firm was involved in designing or setting up the e-commerce system that is now subject to audit. The audit approach to an e-commerce system should include the following elements. 1. First of all, the audit firm should decide whether the engagement should be accepted, as in any professional engagement. 2. The firm should then plan the engagement. An important aspect of planning may be to make available audit staff with appropriate expertise in e-commerce system. 3. The firm should obtain a detailed knowledge of the client's business. 4. It should consider liaising with the internal auditor of the client if there have been internal audit investigations into the client's e-commerce transactions or system. 5. The firm should identify and evaluate the risk in the system. 6. It should ascertain and evaluate the control environment and the specific internal control that are in operation. 7. It may also be appropriate to perform a going concern review, particularly in the case of entities that rely mainly on e-commerce activities for their income. Section 3.6. Continuous auditing. Continuous auditing is a process which allows auditors to give assurance on a subject matter concurrently or shortly after the occurrence of the event on which assurance is being given, and therefore give assurance more frequently by using automated procedures. Continuous auditing requires using automated procedures which are embedded in a client system, so they require technical skill as well as auditing skill. They will require strict control and secure communication links to operate effectively. Subtopic 4. Prospective financial information. Section overview. The nature of prospective financial information, PFI. 2. ISAE 3400. The examination of prospective financial information. 3. Reporting on PFI. That's prospective financial information. Section 4.1. The nature of prospective financial information, PFI. Traditionally, the role of the auditor has focused on providing assurance on historical events, for example, on financial statements relating to a period of time in the past. When an auditor examines historical data, there is usually factual evidence to support the reported figures. This evidence will often come from events that have taken place since the financial statements were produced. For example, receivables may subsequently have been paid. Inventories may subsequently have been sold, providing evidence that trade receivables were correctly valued in the statement of financial position and that inventory was also correctly valued. This evidence is critical to the audit process. As business and economic environment have changed, demand has grown for professional accountants to provide assurance on information relating to the future. Such information is known as prospective financial information, PFI. PFI is widely used both within an entity internally and externally. Internally, forecast and projections Forecast and projections are widely used as a form of management information. Examples include forecast and projections relating to revenue, capital expenditure, revenue expenditure, profit, cash flow, working capital. External uses include profit forecast for providing to the stock market, forecast of cash flow to support an application for a loan from a bank, profit forecast to support or defend takeover bids. The auditing profession has traditionally been cautious about expressing a firm opinion on financial information relating to a future period. However, when an audit firm undertakes this type of work, the work is closely regulated. For example, accountants are required to use very careful wordings in their reports on PFI. Definition: Prospective Financial Information, PFI. PFI is financial information based on assumptions about events that may occur in the future and possible actions by an entity. Forecast. A forecast is PFI prepared in the basis. A forecast is PFI prepared on the basis of assumptions about future events that management expects to take place and the action that management expects to take. The assumptions that are used by management to prepare a forecast are called best estimate assumptions. Projection. A projection is PFI prepared on the basis of hypothetical assumptions about future events and management actions that are not necessarily expected to take place, or a mix of best estimates and hypothetical assumptions. A forecast is therefore a best estimate of what is expected to happen, and a projection is an estimate of what is likely to happen if certain conditions or events were to happen. Both are distinguished from a target, which is what management wants to happen. Section 4.2 ISAE 3400. The examination of prospective financial information. ISAE 3400. The examination of prospective financial information is the main source of regulation in this area. It provides guidance on the examination of PFI and reporting on PFI. It focuses mainly on numerical information and numerical forecast or predictions. Accepting a PFI assurance engagement. Many of the points relevant to deciding whether to accept any audit or assurance engagement will apply to accepting a PFI assurance engagement. Issues to consider will include, for example, the availability of resources and staff with necessary expertise and the time scale for the completion of the engagement, agreeing a fee for the work with the client. The accountant should also establish with the client the form that the assurance report should take. It is particularly important that the client should understand that in a review of forward-looking information, only negative assurance can be provided. The client should also be informed that the audit firm will comply with the requirements of ISAE 3400 when reviewing the prospective financial information. An engagement letter should be agreed and signed by both parties before the work is actually started. Procedures in a PFI assurance engagement. There are several specific points that might apply to PFI engagements. 1. Understanding the nature of the information to be examined. 2. Establishing the intended use of the information and the intended recipient of the final report. 3. Establishing whether the information will be for general distribution or limited distribution to a small number of users. 4. The nature of the assumptions that have been made by management whether they are best estimate assumptions for a forecast or hypothetical assumption for the purpose of making a projection. 5. The time period covered by this information. When deciding the nature, timing, and extent of the procedures required to complete a PFI assurance engagement, the auditor should consider the following issues. 1. The likelihood of material misstatements in the forecast or projections. 2. The knowledge that the auditor has obtained during any previous similar engagement. 3. The competence of the client management with regards to the preparation of PFI. 4. The extent to which the PFI is affected by management judgment. In other words, to what extent does the PFI depend on judgment about best estimates or hypothesis. 5. The adequacy and reliability of the underlying data and assumptions that have been used as the basis for preparing the prospective financial information. The general approach to the assurance work should be similar to the approach for audit work or other assurance work, but with some modification to allow for the specific nature of the work. Procedures will include the following. Where the audit firm has no previous knowledge of the entity, it should obtain sufficient knowledge of the entity and its environment. If best estimate assumptions have been used in preparing the PFI, a forecast, the auditor should seek evidence to support this estimate. If hypothetical assumptions have been used to prepare a projection, the auditor should assess whether they are realistic and sensible, and whether the full implication of the hypothetical assumptions have been properly reflected in the PFI. The auditor should assess whether the PFI contains all the relevant material items and that nothing of significance has been omitted. If part of the future period in the forecast or projection has already passed, the auditor should review the actual results for that part of the period and compare actual results with the forecast or projection. The differences will help the auditor to assess the reliability of the forecast or accuracy of the projection. The auditor should also check the arithmetical accuracy and consistency of the projected financial information that has been prepared. The auditor should obtain representation from management on management acceptance of responsibility for the information, the intended use of the information, the completeness of the assumptions that were made to prepare the PFI. Example, profit forecast. Procedures relating to a profit forecast that the entity will use in support of a bank loan application might be as follows. 1. Understanding the basis of the forecast by asking the person who prepared it. Then test the calculation of the forecast according to its method. For example, if it has been extrapolated from previous results, reperform the arithmetic of the extrapolation. 2. Consider whether the assumptions in the forecast are consistent with each other. For example, will sales grow at that rate without additional marketing costs? 3. Consider whether the forecast is reasonable in the light of known facts such as current economic circumstances, past trading history. 4. Discuss the key variables and sensitivities with management. Often, key assumptions will be estimate of sales demand and sales price and the gross profit ratio. The auditor should establish the basis on which these estimates have been made. 5. Review internal consistency of forecast. For example, has the same interest rate been used throughout the forecast? Has the same growth rate been applied to sales and purchases? 6. Compare assumptions and basis for forecasting with information used internally, for example, by the marketing department. 7. Compare figures with other forecasts to ensure consistency. For example, depreciation should appear in both profit forecast and capital expenditure forecast. 8. Compare figures with any available evidence. For example, cost may be compared to quotations for work to be done. Assess cost for reasonableness. For example, if the profit forecast includes estimates of advertising and marketing costs, do these seem reasonable in comparison with the value of sales turnover and other operating costs? 9. Consider whether all items of cost have been included. For example, if the profit forecast involves the launch of a new product, have all the initial running costs been included, such as initial marketing costs and setup costs for operation? 10. Consider whether the forecast of the amount of finance required allows for working capital. 11. Check that the forecast of profit and cash flow includes the cost of borrowed finance. 12. Check that forecast of cost and revenue allow for estimated inflation. 13. It would also be appropriate to carry out some sensitivity analysis of the forecast of revenue, cost and profit to establish the extent to which estimates in the forecast would need to differ before the forecast profit turns into a forecast of loss. Tutorial note: if you are asked in your examination to list procedures in relation to a particular forecast, you should think what that forecast will contain and what it will not contain. For example, a cash flow forecast will not include amount for depreciation.